folks, welcome to Chapter 7. In this one, we'll be looking at intricacies and turtle soup details. The main topics will be, what are some price action details we should pay attention to when trading time-based models, turtle soup intricacies, and the bulk of the chapter is going to be addressing higher time frame order flow. Because without a good grip on the higher time frame order flow, your turtle soup will fail because you'll be trading the distribution instead of the manipulation, thinking it's manipulation, right? Has that happened to you before? Is you think it's a turtle soup, you go on Twitter, you see me taking the turtle soup, you go into your own chart, you try and take a turtle soup and you fail. It just keeps going higher. You open the chart, you go look at an old high, you randomly short, and you get liquidated. Does that sound familiar? And it probably does. The reason is because you weren't in alignment with the higher time frame order flow. And by higher, I mean relatively higher. All right, 1 hour bullish order flow will give you a 5-minute, 1-minute bullish turtle soup, right? And so on. So when I say higher time frame, I mean relatively higher to the time frame you're looking at right now. That's in specific, but in general, when someone is saying higher time frame, when you hear ICT or me or anyone saying higher time frame, then usually what is referred to is the weekly and monthly charts. They are where the bulk of the volume lies, and they are where smart money and the institutions go hunting. Right? So the biggest moves, logically, will come from the monthly and weekly charts. And speaking of time frames, there are some other ways to customize your time frame if you have TradingView Premium, and that can give you some insight into, for example, the weekly chart before it closes, right, with the 5-day chart. But that's a topic for later. All right? For now, we focus on these 3 points. For starters, you have this picture. This picture depicts a reality, which I will address in the next chapter in detail. But it's the truth. You saw me trade turtle soup. You tried 1 turtle soup, 2, 3, 4, and you quit midway. Here's one thing I'll tell you is, no matter what mentor you go to after me, if you do, I happen to have a quite high retention rate for students. But no matter what strategy you take, no matter what mentor you choose, which I don't recommend anyone except ICT, and if you resonate with turtle soup, then me. And maybe Kish for order blocks, right? But I don't recommend anyone. Why? Because if you have multiple sources of information telling you different things, then you'll be distracted. That's not a good learning environment. Have 1, 2 max sources of information which are in alignment, right? They complement each other. Otherwise, you're prone to committing this error, which is try one strategy and hop on to another one when it fails. There is a more in-depth discussion in the next chapter, but for this one, I will stop there. The learning curve of price action is 4 steps. No matter who you are in the entire world, from the moment you enter the market, from the very moment you sign up to MT4 or whatever broker you have, and from the moment you choose this path as a trader, of course, some sign up before choosing the path. From the moment you choose to be a trader, there's 4 steps you'll go through. Step 1 is receiving the information, and this learning curve is referring to the learning curve of analysis, right? And then it transitions into execution. Step 1, receiving the information. So I'll tell you the stuff I've told you in chapter 1, 2, 3, 4, 5, 6, 7, 8. 6 is cancelled. Step 1 is receiving the information. And some of you were asking me why I canceled it, because the information in chapter 6 is not something I find appropriate to share right now. Because obviously I can't give you everything at once. That is just counterproductive to you. Right? So chapter 6 had some information in it, which I can't say much, but the information in chapter 6 is not at the level that you are studying right now. And I know there's some pretty advanced students in here who might have got their ego hurt by that, but it's the truth. And for those who are observant and astute and have a good memory, remind me of chapter 6 later on. Anyway, back to the presentation. The learning curve, step 1, receiving the information. Step 2, witnessing it work. Step 3, trading what you witnessed work. Step 4 is fixing the execution mistakes. Because forget profiting for a second. If you focused more on correcting the losses, then the only result is a profit, right? So put more emphasis on correcting mistakes rather than trying to discover the Holy Grail, right? If you correct your mistakes, and people have this innate narcissism inside of them, even if they have not earned it, which is, the market is wrong. No, it's not wrong. You're wrong. So fix the mistakes you make when executing. Now to the charts. That little mini introduction / rant over. Price action details. When you open any chart, knowing what should happen is the first step. Bias and narrative. Bias is where, narrative is why and how. What does the process of anticipation look like? Something very little spoken about. Right? They all tell you FEG, order block, supply and demand, volume profile, Elliott wave, harmonics. They tell you how it works, but they don't tell you what you should be doing in the process of anticipation. That will be looked at over here. And what signatures will price demonstrate at the times of creating the low or the high of the candle. Very important. So for your sake, I hope you are taking notes. One of you DM'd me, he showed me that he was taking notes even on my rants. You can do that. I do slip some information mid-rant, so if you are persistent enough to listen, then you have caught them. Anyway, higher time frame directional bias. How does one go about determining the higher time frame bias? Because as we know, it is a critical element of a successful turtle soup consistent trader, is correct identification of the higher time frame directional bias. And this is something I introduced to Twitter last year. Before I came on Twitter last year, I noticed that everyone, with very little exception, were trading market structure shifts and breakers and order blocks, right? Even order blocks, not that many. But they all waited for the market structure shift and the OTE and the FVG. Those are the hot ones. Nobody paid attention to one of the most key elements, and I find that ironic, which is the higher time frame, the higher time frame directional bias. Now, of course, 1 year later, as you can see, the effect is palpable. The higher time frame bias has become the norm. Yet they still don't know all the details, and I will gloss over some in this one. So, how does one go about determining the higher time frame bias? Highs, lows, FVGs, opens, and closes. And before we continue, I'd like to tell something to those of you who don't like the rants. It's understandable, right? But if you can't stand the rants, then you don't deserve the knowledge that comes with the rants or before and after the rants. Ask questions when determining a higher time frame directional bias. Ask questions such as, what is a safe low as a stop loss? What is a conservative target? What opening price are we respecting or disrespecting? What PD arrays are we respecting / disrespecting? What breakers are we respecting or disrespecting? What are the odds a gap doesn't get filled? Because as you may, if you've been trading ICT for more than 3-4 months, then you know that sometimes you mark an FVG and the FVG doesn't work, right? Why does that happen? Why? Are they using down close candles for support? Or are they using up close candles to sell? As we know, smart money buys in down close candles during a bullish or a buy program, and they sell in up close candles when you're bearish. When you ask these questions to yourself, then ask yourself also why. What is a safe low as a stop loss? The low that rebalanced in FVG. Why? What is a conservative target? Those equal highs. Why? Because they overlap with a higher time frame FVG, and a higher time frame FVG, which has equal highs on the low time frame, is a high quality target. That's an example. Market profiles, an important topic. The market makers, they don't move price in vertical lines, right? That's not wise. It's not possible, first of all, due to the amounts traded. And it's not the way the markets move, because if they did move that way, then you'd all make money. No one would ever lose. It's just going up or down. No. What happens is they go in consolidations and then trend, consolidation, trend, consolidation, trend, and every consolidation leads to an expansion. All of them, right? You will never find a market consolidating forever. And if you do find a market that is consolidating for a long time or for an extended period, and I say period relative to the time frame you're looking at, even the consolidation, this one over here, for example, has a trend within it, right? But generally speaking, money moves in consolidations and trends, right? That's how the markets are made. How to identify whether we're trending or ranging. There's multiple ways. the way I use is highs and lows. All right, so are we rejecting lows and breaking highs, or are we breaking lows and rejecting highs, bearish, or are we ranging, which is rejecting, showing lack of will to break out of the high, right? Showing the will to remain in this consolidation, respecting both highs and lows. It's a choppy market. You wait for a gap in one side before exiting the range, right? So when you're ranging, then you wait for a gap to form, and whichever side the gap forms, that is probably the side of the breakout when paired with a false breakout on one side, right? If you didn't catch the last part, then watch it again. Any given time frame, this is an important concept, so I want to give it its time, which is any given time frame is only bullish until it reaches a higher time frame key level. Any given time frame is only bearish until it reaches a higher time frame key level. And this one is a very important one. I've hinted at it publicly, but this slide you're watching right now, this slide is how you're going to trade and make money even when being wrong on the higher time frame. Pay close attention. If you're listening to it, come watch. Put everything down, take your cup of coffee, and watch closely. Any given time frame is only bullish until it reaches a higher time frame key level. Any given time frame is only bearish until it reaches a higher time frame key level. What does this mean? This means that gaps on the 5-minute time frame will only be respected till we reach a 15-minute key level. Order blocks, up close candles, or down close, on the 15-minute time frame will only be respected till we reach a 1-hour key level. A 1-hour key level. Highs and lows on the 1-hour time frame, we will only respect lows and break highs on the 1 hour until we reach a 4-hour key level. Excuse me. Inversely, a 4-hour key level will be disrespected if a monthly key level is being respected, because in trading, everything can be inverted. Order blocks, breakers, FVGs, even concepts. A famous saying of mine is, every exit is an entry and every entry is an exit. Right? And really ponder over that. Ponder over the fact that every entry of smart money is an exit of smart money, and every exit of smart money is an entry by smart money. Here we have the lower time frame. We are respecting bearish PD arrays, correct? Bearish premium PD arrays. Premium and discount, it's a long topic. But in summary, don't buy a bullish FVG unless it's in discount. Don't sell a bearish FVG unless it's in premium. Eliminating the FVGs which are bullish, which are not in discount, will save you a lot of trouble. So now we're respecting this premium bearish PD array. However, we have reached at a discount of this leg, and this leg is more important than this leg because we have a low, we have a high, we have a lower low. Everyone's selling down here, right? And then we have an expansion wave. This is a pattern, but it's also a logic, right? The market makers, of course, when you see the higher time frame, you'll understand, but the market makers sunk price below this low to accumulate as many positions as they want, right? And they will distribute the positions they accumulated below the lows above the highs, one by one, 20, 40, 60. And the market profile tells me we're bullish. Why? Because low, high, lower low, higher high. Expansion wave, which tells me there's another expansion wave due when we reach this breaker. And this is a chart I've called live. It's not some hindsight cherry-picked nonsense. This is a chart I've called live on Twitter for everyone for free. And there was a lot of money which could have been made by this chart. But that alone is not enough. This breaker alone is not enough. If you go to the higher time frame, we're respecting this bearish weekly PD array, right? Sell, 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 all the way down. You look for weekly open, sell in the wick, down. Weekly open, sell in the wick, down. Weekly open, sell in the wick, and it crashes down. So all during a sell program, you're looking to look for sells. Avoid buys in a bearish trend. And avoid sells in a bullish trend. If you focused more on trend versus counter trend trading, then you'd make a lot more money. And all trends start with turtle soup right here. So the lower time frame is respecting bearish PD arrays. However, we have now reached, on the higher time frame, we've reached a higher time frame PD array, right? And as usual, rejection blocks give you a retracement before finally targeting the wick. That's another concept. So, are you bullish or bearish here? Pause the video. Think for 5-10 seconds, because that's the amount you should be spending before spotting something for it to be considered high quality. All right. Have you thunk? I know, of course, some of you didn't even pause the video. You were too lazy. But for those who did, your answer should be like this. If we close below this candle, we're bearish. Unless we close below this candle, we are bullish, because it is a higher time frame key level. All right, so the concept is bearish on the lower time frame, and we've reached a higher time frame key level. All right, so we reached the higher time frame key level in confluence with a breaker, and higher time frame key levels, which are in confluence with lower time frame PD arrays, are high probability. So we go and crash down into the breaker. We then smack into it real hard, which is what I like to see. When I map a key level and we smash down into it, I like to see that versus slowly sinking and dragging it out, because normally when they drag price and it's really taking its time to reach the key level, then I consider that a less quality setup. in general. So we have low, high, lower low, expansion leg number 1. We've reached a breaker in confluence with a higher time frame key level. We close above this candle. We close above this candle. And from this moment onwards, you have this as your stop loss. The low over here. All right? Some things to note. The important prices to label on this chart when you have a change in the state of delivery is the open and the close. Right? Down close candle. They dug into this low, confluence with this high, closed above it. Candles are ranges. Right? So we have a breakout over here. That's why an order block works. Note this and this. Many a time you'll note this. You'll wait for a 1-minute reaction. It won't happen and you'll say ICT sucks. No, you suck. Because you're supposed to be expecting a deep dig into the order block, potentially the rejection block, and then it goes higher. Whenever there's an order block, always consider the chance that the rejection block does it. Excuse me. And as we see, indeed, we stabbed into the rejection block. Wicks do the damage, and bodies tell the story. We wicked into this order block. We respected the rejection block, because usually what you'll notice is that rejection blocks are usually retraded to more often than not. So if you have a long wick or even a stubby wick, right? If it's not a thick candle and there's any form of wick, then consider that price will go and fill that inefficiency, because that's what it is. It's a form of inefficient price which needs to be rebalanced. Now, next on to the topic of closes versus wicks. Close above equals higher prices. Close below equals lower prices. Wick below equals higher prices. Wick above equals lower prices. In this example, we have a range, prices ranging, right? Now, in every single range, we have a range high and a range low. What does this mean? This means smart money is accumulating. What does that mean? It means they're generating interest on both ends of the range. They're breaking down, and I like ranges to happen over an extended period of time. If it's 1 or 2 candles, no, it has to be multiple candles. 20, 30, at least 20, right? So I like price to range for 20 candles, and then accumulation, generating interest on both sides of the market. So we have buy stops up here, sell stops below here, right? We then dig deep into the sell stops. Everyone's bearish down here. In fact, this is also one I called live, but I don't think I was on Twitter back then, so I had to witness it with my buddies. Down here, everyone was very confident in gold being bearish. And this is gold monthly chart. Except me. And the reason was, this is spring. If for those of you who have studied Wyckoff, that is one way to look at it, which is a spring. And my buddy, who's also a trader and an analyst, he told me that Check out gold. There's a spring on the monthly. Right, spring, which is another way of looking at turtle soup. It's quite primitive. You can research it if you want, but it's quite a primitive level of turtle soup, not quite as deep and thorough as what I teach. Sorry, Wyckoff. Now, he's dead, so it doesn't matter. Now, the thing I want you to see in this one, and excuse me, the thing I want you to see is range, accumulation, manipulation, bullish from here, distribution. As soon as we close above, if you notice, all the way down here, we didn't close above, not a single candle. Below, 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 below. Right? So when we close above, this is a change in the state of delivery. So now we have taken the range low. We're targeting 50% of the range and the range high. All right? In this instance, at the time of the creation of this order block, right over here, many people would have been buying at the open because they are pattern traders. Every single time I see an order block, I expect a deep dig into it and then a rally. And remember, we always mark the rejection blocks, right? Because there is a lot of liquidity that likes to rest at rejection blocks, right? Both bearish and bullish. So, how do you read this order flow? This is a monthly chart, right? You read it as follows. Are we closing below candles or are we closing above candles? Closing below, closing below. Have we closed below the 50% of this candle twice? Nope. What is the important low which signifies a change in the trend from bullish to bearish? A close below this low, right? So unless we close below this low, you can't target any lower than the low itself, right? You can target this as a turtle soup candidate to the body or the wick, right? Because when you, for those of you who actually did the exercise I told you to do, which is removing the wicks, go to your charts when this is over. All right, that's your homework, is go to the charts and remove the wicks and look at price through the lens of no wicks versus with wicks and see what you observe. So we're closing below this candle. Now, it is valid to sell or consider a sell at this order block over here. All right, we're closing below this, closing below this, closing. However, we do have a potential reversal zone at the rejection block, right? The opening price didn't support, the 50% didn't support, and the next stop is the rejection block, right? And this is a good example of trading the PD array itself or the journey down to it. If the opening price is not being respected, then trade the journey down to the 50%. If the 50% is not being respected, then open the 4-hour time frame and trade down to the rejection block, and so on. So we're bearish right now. Yes. In this price leg, yes, we are. Clearly. However, this happened, which is the order block, which was bearish, has now failed. We've closed above. As soon as this happens, you now have a candidate. Of course, you have the rejection block. The body has been taken. You have a candidate for a kiss of death turtle soup on the lower time frame, and that is a model I've taught publicly. You can go to the public Telegram and check it out. And this is also another model of mine, which is the failed order block model. More on that coming this week, perhaps. All right, so now we have a clear directional bias. This is a failed order block, and it is one of the most powerful patterns, quote unquote, which you can trade. A failed order block will lead to an expansion to the high of the failed order block's price swing. If you didn't catch it the first time, replay. A failed order block, right? So at the failed order block level, usually you'll have a not failed, a successful, a real order block, right? Fake order block, real order block. Because if we're disrespecting the bearish one, then we must respect the bullish one. There's no third option. Right? So the failed order block produces an attack from smart money on the high of the price swing of the failed order block. All right? Pair that with range high, range low. Target is going to be, this is a magnet over here. You have the equal highs. So the magnet is up here. And this chart is not some hindsight cherry-picked nonsense. This is a chart I traded myself, and I warned you where it's going to go. Right from here. So when you're down here, I had warned of I had freely given out money to the world by telling you that from this point onwards, gold is going to go to all-time highs. And over here, stick to the bias as long as we don't close below the rejection block. And of course, not surprisingly, range low, range high. Trading this, what would the anticipation look like? All right, so this is the real monthly order block, which is produced. You have the monthly opening price marked out beforehand, and you have the monthly order block marked out beforehand. Open, do nothing before we reach the monthly order block. We reach the monthly order block in week 2 of the month. As we know, week 2 and 3 have a high chance of producing the monthly high or low, especially week 2, right? And as we know, I'm looking for open, decline into key level violently. That's what happened. And at the key level, we show signs of bullishness. Right? Starting with this wick below, at key level, higher prices. And this is the framework, range low, range high, breakdown. Everyone's bearish. You're probably bearish if you're watching this right now. But every downtrend has to end at some point. Right? Every bearish trend has to finish. And that is what we are doing, essentially, with confirmation. So from here onwards, it saw nothing but up-only price action. Of course, range, beautiful. There's always a range at the high and the low of the candle with an SMT. Always. Open, decline, smack into key level. Candles or ranges. Range down here, range low, range high. So range below range low, range high, range low, and we rally violently from there onwards. And this was another Monday low of the week. Remember, you were on the last presentation. Same thing. Sunday, Monday, Tuesday, Wednesday. Well, Sunday. Monday, Tuesday, Wednesday mark the low of the week. and Thursday, Friday mark the opposing end of the range. Another example of order flow being bullish or bearish until reaching a key level. Over here we have a daily chart. Closing below candles, respecting bearish PDRAs, disrespecting bullish ones, so we're bearish. But we're only bearish on this time frame until we reach the higher time frame weekly key level. Right? And at the higher time frame weekly key level, we look for a close above. All the way down here, almost 2 weeks. Right? Not a single close above the candle was happened. Right? There was not a single candle closing above a previous candle. Close below, close below, close below, close below, and so on. Until this point, we came here, we closed above this candle's high and this candle's opening price. Right, it's an order block, candles are ranges, wick through the range, and now we're closing above the opening price. Using that opening price and this candle's high as a pivot point for a potential entry, right? So from this moment onwards, we're looking for a classic buy candle. And we were bearish all the way down until we reached the higher time frame key level than the current time frame. Close above and rally. Bump in the previous candle's high. And that's all she wrote. Now, where does turtle soup fit in? The answer is everywhere. Turtle soup above this high. Turtle soup below this low. There's always a turtle soup and or a failure swing in every single chart you see. Going back to the previous examples, skimming through them. Same thing, turtle soup, turtle soup, turtle soup. It looks cherry-picked in hindsight, but this is a trade I took by myself, and you've seen me call this for the past year with an accuracy of over 80%, a little bit over 80%. That's something you will never see anyone do, ever, on Twitter. Unless they are one of my mentees, then perhaps. But don't be discouraged if you see the turtle soups after the fact, but you seem to struggle seeing them during the fact. That's normal. That is part of the development, and you must persist and ask yourself why. Is it because you're blindly entering? Are you looking for SMT? Are you looking for a change in the state of delivery? Are you waiting for closes? These are all questions you should answer yourself. As I said before, you have the open. This is how I view any candle I trade. All right, and this is a deeper look into my brain. Open. Rally. Excuse me. The first voice crack in this mentorship. Open. The higher time frame daily is bearish. Open. Rally. Range. Turtle soup. Decline. That's during 1 o'clock onwards. And then you have this. At 9 o'clock, you expect a rally, turtle soup, and continuation. All right? Expansion leg number 1. Protraction. Expansion leg number 2. And that marks the end of chapter 7. Good luck. Good studying. It is very dense, so study it well. Repeat it a couple of times, because there's no way any of you grasped all of that in the first take. So study it again. Some of you reverse engineer everything I do and say. That is a That's the best way to learn from someone. If you want to emulate them, do that as well. And really take notes. There's a saying in Arabic. It's العلم صيد والكتابة قيده قيد صيودك بالحبال الواثقة, which translates to knowledge is a prey and writing is the net or the rope. Catch your preys with thick nets or thick ropes. And on that note, I wish you good luck, good trading, and see you in the next one.